here, but if you want more of that, you can always go to one of these workshops that are they're free. So you can always go to one of those, and get more of what we're going over here. Want to make sure that if we don't, it's never enough time in the session. So anyway, there you go, and there's a link in the chat. All right. Occasionally I do, but the guy that does is he's fantastic. He understands supply and demand and trades options, Forex, and yeah, he's great. All right. So take a look. Right here. There we go. Here is today's topic: 3 key mistakes novice traders and investors make. Whether you're trading stocks, futures, Forex, options, cryptocurrency, you name it. There are 3 key mistakes that are responsible for the vast majority of traders and investors either losing money or not achieving their financial goals. We're going to cover those 3 mistakes today and start to dive into how to do this right. Where my experience comes from is the trading floor of the Chicago Mercantile Exchange, where I started out on the trade desk and facilitated institutional order flow. By tracking where those who were consistently were those who really made money were buying and selling versus those who didn't, it was very easy to see again what the profitable people are doing right and what the novice trader investor is doing wrong. And when you have the actual buy and sell orders in front of you, like I did, it just jumps right out at you. It's crystal clear. So I'm going to map that out for you here today. And to start with, I'll start with a very simple question. I asked Google a little while back, what percentage of traders lose money? Google says 96%. That number seems pretty crazy, right? What are we even thinking about here with a number that high? Why in the world would you want to get involved in something like this? Now, if you think about your average, major financial institution, Wall Street bank, big dealer desk in the Forex markets, do they make money? What's their track record generally? How do they do? They tend to do pretty well, right? In fact, they tend to make quite a bit of money, tons of money, yes, every year, no matter what the markets do, whether they go up, down, or sideways. So what's going on here? All right, and this is what really hooked me into this business many years ago when I was on the trading floor. I saw that professionals, financial institutions, money managers, and I started on that side of the business, right? I started on the professional side of the business. I worked for a big firm handling order flow, facilitating order flow. So I saw the orders. I had the orders. It was my job to facilitate those. So I saw that group was right in their decision-making process most of the time, and as a whole, made lots and lots of money. At the same time, the average retail trader or investor, whose orders we also saw some of, tended to be wrong in their decision-making process most of the time, and as a whole, either lost money or didn't come close to achieving their financial goals. But the big light bulb for me was when I realized, wow, this group is so good over here, this group is so bad, and they're both buying and selling in the same markets. Right? Prudential Beige back then, Sam Bragg. And so think about that, right? And the answer is the same today. Would you agree? Right? That group, the professional group, does so well and makes so much money, and most everybody else doesn't. But they're both buying and selling in the same market. So what is one group doing that the other isn't? And when I realized that, I focused on the buy and sell orders, and I mapped that out on a price chart. That was back in the 90s. And the strategy ever since then has not changed one bit. But I want to share this with you for two reasons today. One, so you can avoid these three mistakes, right? And avoid being a part of that 96%. And then start to clearly explain strategy rules that the professionals use. Does that make sense? Are we ready? If you have any questions, always chime in. But here we go. So 3 key mistakes. They buy after a rally in price, the novice trader and investor, and they buy at supply or retail prices. They sell after a decline in price and at demand or wholesale prices. And the third mistake, they buy or sell at fair value, which is right in the middle. Now you may think, oh, wait a second, do people really do this? Like, why would someone buy after a rally in price and at supply? Who would sell after a drop in price and into demand? The first thing we're going to do is understand, yes, the 96%. We're going to understand why people do that. So let's take a look. Okay. So I then asked Google, what are the most popular trading strategies? And look what Google says, right? The most searched trading strategies. Trend following, right? Fibonacci is in there and all that, right? It's all in there. So real quickly, before we go on, looking at the screen here, what's one thing you can stop doing right away to help ensure that you're not a part of that 96%? What's one thing you can stop doing? It's kind of on the screen there, the answer, giving the answer away. But what's a simple, stop following trend. Stop buying after everybody else does and selling after everybody else does. Now, some people might think, wait a second, trend trading, that's the most popular thing out there. Every trading book ever written talks about that, right? Well, let's just give me, 30, 45 minutes and hear me out. And I will show you how this works. Okay. Don't be afraid to think a little bit different, right? Don't be afraid to think a little bit different. So the supply demand strategy, right? So we've named it the Pinnacle method, a rule-based strategy that quantifies supply and demand in any and all markets and any and all time frames. Day trading, swing trading, longer term investing. Okay. There you go, Sam Bragg. Well done. And I know you kind of get what we're talking about here because you're in a lot of these sessions. So here's how markets work, right? Demand, supply, fair value. Demand is where we buy. Supply is where we sell. We either get paid because we're in a position or do nothing in the middle, right? And let me show you something real quick here. Let's start with this one. And I want to make sure you understand how all this works. And then I'm going to kind of hit you between the eyes with something you may not be thinking and may have never considered before. Right? So understand, right, that it's all about supply and demand, right? And supply and demand is everywhere in a market. Every time you have a trader transaction, it's because a buyer and a seller agree on a price. And there are supply demand imbalances everywhere. What we care about are identifying the significant supply demand imbalances, which is where price always turns. It has to. So, but let's focus on this middle first. Understand that in the middle, in any market, this is where the majority of trading activity takes place. Probably higher than 90% of trading activity in any market takes place in the middle when you look at the actual volume. And you can see that, right? Yeah, Mark, they kind of have, yeah. Yeah. So I'll leave that alone for now. But yes, So, but I want to share this with you. What we're going to get to after this, I think you'll see, will answer a lot of questions. So, the understand that the middle fair value, that's where the majority of buyers and sellers in any market agree on price, right? That's why you have the majority of trading activity happen in the middle. So the middle acts as a magnet for price. Another way to think about it is at supply, and think of the pure definition of supply. At supply, there is competition to sell, which pushes price down. Because once, right, when supply exceeds demand, once the last buy order is filled, you have sellers left over that are competing to sell. That's always going to drive price lower. It has to. So supply pushes price lower, demand pushes price higher, fair value in the middle pulls price back to the middle. Does everybody understand that? If you haven't already thought like this, start to think of this concept of push and pull. That's how every market on the planet works. Okay. Supply, retail prices, demand, wholesale prices, fair value. It's how anything is priced. We're talking about trading markets today. We could be talking about, I don't know, the toilet paper at Costco. We could be talking about the avocados at the grocery store. It doesn't matter. It's the same concept. What matters most is what does this look like on a price chart? And we're going to spend time on this. Understand that the price action in the middle is represented by the majority of trading activity and this wide and whippy trading activity. Think about it. If we have a significant supply-demand imbalance, which we don't here in the middle, okay, the picture would never look like this. This tells us that we don't have a significant supply-demand imbalance in here, which means we don't want to be taking any trades in here, right? Why would we want to do that? Okay. Out at supply, very little trading. We have our pattern, and we'll go into that a little bit later. That represents supply, our pattern that represents demand. And again, if either of these types of opportunities were in the middle, the picture would not look like this. Okay. Now, let's go back. So, how is this number so high? And nobody knows exactly what that number is, but it's pretty high. Well, think about it. Here's our strategy that we go over in all these FXStreet sessions, and I think we've been going over the same simple rule-based strategy of demand and supply here in these FXStreet sessions for, I don't know, going all the way back to maybe 2010, 2011, at least 9 years, 10 years. Oh, at least 10 years now. Yeah. Wow. Anyway, and this is how you make money buying and selling anything in life. This is how the professionals think. This is how, you know, Goldman Sachs makes money. This is how Costco makes money. It's the same concept. But what does everybody else do? To understand what everybody else does, we have to understand how everybody else thinks and how everybody else is taught. Let's focus on these 3 mistakes that the novice trader and investor makes that almost guarantees that they're not going to be successful over time. Okay. As we said, right? They buy after a rallying price and net supply, sell after a decline in price and net demand, buy or sell in the middle. Why? Why would people do that? Here's the answers. Let's go over different strategies. What are the most popular strategies? And all of you know them, right? What are the most popular trading and investing strategies on the planet? Let's go to trend first. Anyone who incorporates trend into any part of their decision-making process is not buying at demand. Instead, they wait for price to turn at demand, and they wait for a series of higher highs and higher lows, and then they buy. Instead of selling at supply, they wait for price to turn at supply, and then they wait for a series of lower lows and lower highs, and then they sell. Where are people who follow trend always buying and selling? Right in the middle, which is why we call it the novice space. Does that make sense? By definition, you're always buying right in the novice space, not at demand, not at supply, right in the middle. And this is the most popular trading strategy in the world. But don't forget, there's a reason why the majority of traders and investors don't ever come close to achieving their financial goals. And there's a reason why your average major Wall Street firm makes a ridiculous amount of money. Next one. Maybe you think of news. Maybe maybe you focus on news to make buy and sell decisions, right? Good news typically means that prices are high. Bad news, prices fall, right? So buying and selling based on the news, you're almost always buying at or near supply or selling at or near demand. Does that make sense? That's an easy one. I know everyone kind of knows that, right? Does anybody, I'm not sure if there's anyone in the live sessions with me back in March of last year? Anybody in those sessions during the COVID crisis? What were we aggressively focused on in March of last year with the COVID market sell-off? Buy, yep, looking to buy at those demand zones in the S&P, the NASDAQ, all those stocks and other markets. Yes, buying higher time frame demand. Exactly, Thomas. Remember that? Okay. The news was bad. The majority of the world was selling, which brought in all that supply that pushed price down until it reached a price level where there was enough demand to fill all those buy orders. That's going to be down here at demand. So while the news was bad and most people were selling, right? We were focused on buying because prices were at demand, and we've gone up ever since. Perhaps you use indicators and oscillators, right? Perhaps maybe moving averages or any of the others. There's a whole ton of them. The problem with using indicators and oscillators is they all lag price. That's what they do. A moving average is just that. A moving average, okay? It's always going to lag price. Adding anything to your buy and sell decision-making process that lags price, by definition, only adds risk and decreases reward or profit potential. Make sense? For example, here, price coming back down to a demand zone, which if you've been in these sessions before, this is the time to buy. This is the buy signal for us at demand. Here, the moving average aren't going to cross till up here, which is where the majority of people will start buying. Don't forget, whether you're a short-term trader, a swing trader, a longer-term investor, there's only one way to make money at this. When we buy, right, others have to buy after us at higher prices for us to profit. If we sell or sell short, others have to sell after us, right, at lower prices. That's the only way to make money at this. How about the next one? Before we get to the next one, are you starting to understand why the majority of people lose money? Right? I mean, all the popular trading strategies, not just out there today, but forever. If you go look at books and research back, this is what everybody does. It's unbelievable. People are literally trained and conditioned to buy after a rally in price and sell after a decline in price. If the average person, okay, just think about it. Imagine that you never went and researched any trading strategy or any trading education out there. Let's say you wanted to get involved in this. You never went and researched anything. You never signed up for a course. You never looked for a book. Okay? Let's say you never did any of that. And you just thought about it yourself for a minute. Say, okay, I want to get involved in this trading and investing thing. What's the first question you would ask yourself? Right? You want to figure it out. So what's the first question you'd ask yourself? You'd probably ask yourself, how do you make money at this? And you clearly see, okay, when you buy, price has to go up. And then and only other people are going to make that happen. When you sell, price needs to go down. So your next logical question would be, okay, well, where does price turn higher and where does price turn lower? And you'd probably logically think, okay, I already know that, right? Exactly. Right? Your answer to that would be, well, prices turn higher at price levels where demand exceeds supply. We all learned that in grade school or high school, right? Prices turn lower at price levels where supply exceeds demand. You see what I'm saying? Here, when I was on the trading floor, I was kind of excited in the beginning. I'm like, ooh, I'm going to learn the big Wall Street secret. How do they make so much money? Well, the big secret is not a big secret at all. It's pretty simple. What the professional knows that everybody else doesn't consider is this. How you make money buying and selling anything in life is exactly how you make money buying and selling in the financial markets. The problem is the average person focuses on all these goofy strategies that have nothing to do with how you make money buying and selling anything in life. Let me ask you this question. Okay? Let me ask you this question. If you applied any of these strategies we're going over here to buying and selling anything else in life, how would you do? Let's say you had a business and you operated like that. You would be done in a hurry, right? Okay. So Mark, yeah, I'm not with OTA anymore, but I was in charge of education there up to about 2017, and ever since then, yes, the strategy, as you're pointing out, has changed quite a bit. So, but yeah, but let's anyway, let's keep going. So, let's go to another one. Let's look at another one. How about this one? Conventional technical analysis chart patterns, right? Some might say like the Bible of charting, right? Anybody have a favorite chart pattern? Go ahead and put it in the chat if you do. And I know nobody's going to put one in the chat because you probably assume I'm going to beat it up. But anyone have an old favorite? And it's okay. It's triangles, double tops, any of them. Name any of them. They're all different versions of the same thing. And there's a reason why it's nearly impossible to produce a low-risk, consistent living using that conventional technical analysis chart patterns. All right. How about this one on the screen here? One of the most popular in the world, right? The Head and Shoulders or what have you, or is this here's the double bottom. I'm sorry, the double bottom. Let's look at this one. That's a pretty popular one. Right? So you have one low here, you have another bottom here, and then you're supposed to draw the neckline according to the books, right? And then what are you supposed to do right here? You buy on the breakout, right? Yeah, those triangles, wedges, I see what you're putting in the chat. Okay, what's the problem with every single conventional technical analysis chart pattern? What's the massive flaw in where you're supposed to buy and sell? What's the problem with these patterns? Sam Bragg, it wouldn't be that bad if it was the middle. It's much worse than buying and selling in the middle. You're literally buying after a huge rally in price and selling after a big drop in price. and which always exactly, Michael, leads to increased risk, reduced profit potential. What's another one? Someone hasn't named it yet. There's another one that a certain company out there made popular in the stock market. I don't want to like get anybody in trouble or beat anybody up, by name, but there's a very popular one that it has to do with stocks that certain company made popular. Yes, Daniel, all the entries are breakouts in all of these, correct? Right. In other words, you're not buying down here, you're buying way up here. Right. What the cup and handle. Everybody ever hear the cup and handle? I'm sure everybody knows that one. Think about that. Right? You have to, yeah, it's very, very popular, right? So I know there's probably not a lot of stock people in our group here, and that's okay. Yes. So think of that for a second. You have the cup, and then you have the handle, and then you're supposed to buy the breakout. I mean, you want to talk about being the last buyer. So I think, we can go on and on with these strategies. The problem with these strategies, they have nothing, they're almost completely opposite of how you make money buying and selling anything in life. How does Costco make money? Over here on the left, they buy at wholesale prices, sell at retail prices, right? How does Goldman Sachs make money? They buy at wholesale prices, sell at retail prices. What if any of those companies and all the others used any of these strategies over here? Any of them? They'd be out of business pretty quick, right? You think Goldman Sachs says, wait, don't buy yet. Let's let price go up first and then let's buy. You think they do that? You think at Morgan Stanley, right? At the big trade desk, or one of the big hedge funds out there, they have a meeting every morning before the markets open with all their top traders and say, all right, everybody in the meeting here, who's found the chart patterns today? Who's found the head and shoulders? Who's found the shooting stars? You think they do that? No. And I know, look, a lot of people are going to really want to beat me up for delivering this webinar. But I'm here for you. And listen, I'm just the messenger of how, one of many messengers of how markets really work. That's all. And, if I can save you some time, hopefully save you some money. You just need to be aware that all these conventional strategies out there literally have you there's a reason for this. That's why these numbers are so outrageously lopsided. Does that make sense? Now let's look at some examples. Okay. So here's one where this is just a week or two ago. There was a head and shoulders pattern that we found, right? If you looked at oil, this is the oil market. Anything we're talking about here applies equally to stocks, futures, forex, whatever, any time frame. And on the internet, again, this is one of those popular trading strategies. Here's a lesson on it, right? And this one's from a broker. Here's what you're supposed to do. And here's where you're supposed to enter the position. Right down here is where you sell short. See that? So you're not supposed to sell up here or over here. Wait for prices to drop and then sell. Does that make any sense to anyone at this point? Now, if you look at this same example, we had that same opportunity. However, in one of our programs, we give supply and demand levels each day in a lot of major markets. So in this same opportunity here, we identified a supply zone, right, where banks and institutions were likely selling oil up here, right? And what told us that? Well, our strategy rules. Very little trading here. We have the pattern, price drops in strong fashion. A couple other little things. When price comes back to this level, right, the opportunity is to sell short to the buyer who's buying after a rally in price and at supply, right? This person right here, buying after a rally in price and at supply. There they are. Okay. Then when price falls, right? So if you sell short here, now you're in the position, right? And that was the supply level we had for oil that day. Now you're in the position. Now when price breaks below here, who's going to start selling here? All the head and shoulders people. See how that works? Okay. You know, answering these two questions are the most important thing when it comes to proper trading and investing. Where will price turn? Where will it move to? Okay. And the answer obviously is supply, demand, fair value. Okay. Michael, no, the stop doesn't have to be wide, and if it is and it doesn't meet your trading plan, then don't take the trade. Not a big deal. There's plenty of opportunities, or find these opportunities on smaller time frames. All right, so the key is to know what this looks like on a price chart. How do you know that you have a supply zone up at supply and not down in fair value or the novice space? We call it the novice space because that's where novice traders and investors buy and sell. All right. We want to focus on demand and buying at demand, selling at supply, because that's where probability is highest and profit zones are large. Let's look at some opportunities from this week in a second. We'll after this one, we'll look at a bunch of opportunities from this week. So I want to show you what this looks like on a price chart. Here's a screenshot from one of our live sessions. We do live sessions every morning. And notice we have, so step one is, where is fair value? Where do the majority of market participants agree on price? It's right here. How do we know? This is where the majority of trading activity took place. Okay, so that's the middle, the novice space. We then identify the pattern, the price picture that represents fresh significant supply, which is here, and demand below. Right. Another way to say that, we're willing to sell at supply or retail prices to someone who's willing to buy there. A little bit later, price rallies up to that supply zone where someone, a novice trader, is making the two mistakes of buying after a rally in price and into a price level where the chart already told us or suggested supply greatly exceeds demand. Price then, that competition to sell at supply, as we said, naturally pushes price down. That's what competition to sell does. Does everybody understand that? It pushes price lower. Fair value down here, which is where, again, the majority of buyers and sellers agree to buy and sell, is going to pull price. It's that whole push-pull concept. That's how supply and demand in any market works. When we look at yesterday, this is a screenshot from yesterday's live session. We identified a supply zone in the S&P. Now, the market hadn't opened yet, but pre-market trading was right down here. So we knew yesterday, right before the open, that the market was going to gap open, right? It was going to gap lower. Why was it gapping down? You can see it gap down to here. So why was the market gapping down yesterday in pre-market trading? Because supply exceeded demand here. That's the only reason why prices fall like that. The fact that we had so little trading in here suggested there was a significant supply-demand imbalance here. Make sense? Right. Buying and selling is going on. All of a sudden, the last buyer buys at this price. you have a significant amount of supply left over, price is going to move lower, as it did. The market ended up gapping lower, gapping open to the downside, like we said. Then a price rallied up to the supply zone, where again, someone was buying after a rally in price, mistake number one, and buying into a price level where supply exceeds demand, mistake number two. Right? The smart money is the seller here. The novice trader or investor is the buyer. Price then falls through the profit zone as demand was much lower. This is yesterday and this is into today. Make sense? Good question, Mahesh. Should I keep target at fair value or opposing zone? So yeah, I was going to talk about that if we have time. What you want to, here, take a look. Let me go back here for that. We don't have a lot of time, but take a look at this. You see how in this opportunity right here, fair value happens to be here. So what's nice is this opportunity is offering you, I'm just eyeballing it, but like maybe 2 or 3 to 1, just back to fair value. Forget demand for a minute where demand was, but this is offering you 2 or 3 to 1, just back to fair value. So that's ideal. Sometimes fair value will be even lower. Okay. Sometimes it'll be higher. But depending on where it is, when you have, when the profit, when the risk reward that you're looking for is taken care of or offered to you just back to fair value, can you see how that's higher probability? Can you see where I'm going with that? Because I think a lot of people just focus on, okay, I'm going to buy at demand, sell at supply, buy at demand. Yeah, that's fine. But what's the odds that that's gonna happen? How long is it going to take for that to happen? Most importantly, is there more evidence or information that we can get that helps us answer those questions? And a focus on fair value does that. Does that make sense? Okay. All right. So that was the S&P yesterday into today. Same thing in the NASDAQ. Yesterday, our supply zone here in the NASDAQ already had one pullback to it, meaning once supply was created and shown to us, price had come back into this level once, but notice it didn't go deep into the level and fell. That gave us a big clue that there was a significant supply-demand imbalance here on the supply side. Right? A little bit later, price rallied up into this level again, offering a low-risk, high-reward, and high-probability shorting opportunity in the NASDAQ. And yesterday and today, price has continued to fall. We can apply all of this, right, to any market. Here's the New Zealand dollar over the past few days here. Haven't updated this. This chart isn't updated, but take a look. Here's an example on the demand side, and we can go to a Forex market. It doesn't, whatever market we're looking at doesn't matter. But here I want to introduce something else to you that you may not be considering. So here we have our demand zone, right? The picture of demand, the pattern of demand, all our rules apply to this one. And that suggests there's a significant supply-demand imbalance on the demand side. This picture strongly suggests banks are buying this market right here at wholesale prices. A little bit later, price comes down to our demand zone here, which means someone is selling after a decline in price, mistake number one, selling into a price level where demand exceeds supply, mistake number two, banks are buying, which means we can be the low risk, high reward, and high probability buyer from this seller if we want to. But notice this opportunity had something else making it higher probability. How about if we add an inverse market? Why not? When we have the opportunity to do that, why wouldn't we do that? And the whole same supply, demand, fair value rules and concepts applies equally here. You see what we're doing here? Okay. So at the same time, the New Zealand dollar, which is against the US dollar in this case, is into demand. The US dollar index had rallied up to supply, which means people were buying the dollar after a rally in price. into a price level where supply exceeds demand. Banks were selling. Okay, with a nice big profit zone below. Look where fair value was. Remember, fair value is going to pull price down. Competition to sell its supply is going to push price down. That's going to help this market go up. Exactly. Conviction, trust, right? You have to trust. Yeah, exactly. Exactly. All right. So I've got more examples that I want to share with you, but I know we're out of time here. So hopefully that was helpful. And if you have any questions, there's a link in the chat. These workshops go a lot longer than our sessions here at FXStreet. So if you want more information and to go over more of this in detail with more time, you can always click on that link. These are free virtual sessions there, and we'll get more of your questions answered. But the goal today was to just maybe enlighten you on why the majority of traders and investors lose money. All right, so there's the link to the session if you want more, and have a great day, everyone. We'll see you next time.